Hello, everyone. Welcome to the quarterly investor call for the UTI India Dynamic Equity Fund. The agenda for today's call will be an introduction by Ms. Shweta Runta, our investment strategist at UTI International, followed by a macro update on India by Mr. Vetri Subramaniam, the Chief Investment Officer of UTI AMC, followed by an update on the fund by Mr. Ajay Tyagi, the portfolio manager for the fund who's been managing the fund since its inception in 2015. We'll now begin the session. Kindly note we'll have a Q&A session at the end. Feel free to post your questions in the chat box at any time during our call. I'd now like to invite Shweta for an welcome address.
Thank you,
Over to
Neha. Good evening, everyone, and thank you for everyone who's managed to join the call today. Heading into 2025, we find ourselves in an economic environment marked by heightened uncertainty. The global order is shifting and fresh risks are emerging. As per an outlook report by World Economic Forum, 56% of economics expect that global economy is going to weaken this year, while only 17% believe that conditions are going to improve. Moreover, growth isn't just slowing, it's diverging. The US is holding strong. South Asia, particularly India, remains resilient, while Europe faces a gloomy outlook. And China's growth is expected to decelerate further this year. Layered on top of this is the resurgence of geopolitical tensions. The recent announcement of tariffs by the US, 10% on Chinese goods and possibly 25% on imports from Mexico and Canada. This isn't just headlines. Economists project that these measures could add 0.5 to 1 percentage point to US inflation through 2026. This has put a wrench into monetary policy expectations, triggering the will they, won't they cut rates debate all over again. The Federal Reserve, which was earlier expected to cut rates, now faces a narrowing window, with some suggesting that rate cuts might be off the table for the foreseeable future. Meanwhile, financial markets are grappling with their own reality check. After the strong rallies of the past 2 years, valuations are stretched. Data suggests that equity markets may have already borrowed returns from the future. The animal spirits which were driving markets for the last 2 years are now fading. And we're entering a phase where fundamentals and not momentum will likely drive outcomes. So where should investors focus? This is not the time for speculation. It's time to anchor your portfolios in assets with real intrinsic value. Countries with high internal rate of growth, or companies with strong balance sheets, resilient cash flows, and the ability to withstand slow economic growth. Please remember, in a bull market, a rising tide floats all boats, even the weaker ones. But when the tide recedes, only the sturdy boats stay afloat. So the question to ask yourself today is simple. Are you in a solid, sturdy boat? Because the tide is already receding and the year ahead could be choppy. Thank you, and over to you, Neha.
I'd now like to invite Mr. Vetri for a macro update on India. Over to you, Vetri.
Yeah, hi. Good morning, good afternoon, good evening, wherever you're joining us today for this call. I hope my voice is clear because I was picking up a little bit of static just before I got started. So Shweta, if you can just signal.
Yes, Vetri.
Okay, perfect. Yeah, great. So what we are going to do very quickly is just run through, some of the key issues which will give you some perspective. And I've seen some of the questions that came in, and maybe in a way, some of the things that we discussed right now during the presentation will address some of those issues. And interestingly, this is also the week in which we just got the union budget, which was presented on Saturday. And I'll talk a little bit about that as well. But just first, I think it's important to remember that India sort of sticks out in terms of both fiscal and monetary policy relative to the rest of the world, particularly in terms of how the policymakers have behaved over the last 3 to 4 years. One of the reasons why growth in India surprised to the downside in the second quarter ended September 2024 is the extent to which the government has continued to focus on fiscal consolidation, and I'll talk more about that later. But here in this chart, what you see over here is a measure of the fiscal impulse, which is to say, on a rolling 12-month basis, how does the fiscal deficit compare to its value 12 months ago? Now, because India has cut its fiscal deficit from 9.2% to 4.8% in the current year, this brings us back almost to the level of the fiscal deficit that we had in FY19, which is the year before the pandemic hit. As a result of this, the fiscal impulse to the economy has actually been negative, and particularly consistently negative over the last 2 years. So some part of this fiscal discipline has also turned into a drag on GDP growth. If we quickly jump through to the next slide, here we'll shift the perspective from the fiscal side to the monetary side. Now, as far as monetary policy is concerned, India moved to inflation targeting sometime in 2016, and the RBI has been quite conservative, particularly over the last, I would say, 18 months in terms of the contribution of M0 to the growth of M3 in India. It is much lower than their historical trend line. What has happened as a result of this is that the central bank has not been creating much liquidity. A lot of the balances of the union government are running in positive balances with the central bank, and as a result of that, liquidity has actually been quite tight in the system. Now, those of you might remember that the Monetary Policy Committee in India actually started hiking rates in early 2022 in response to the high inflation. What you'll see on this chart is that beginning that same point in March 2022, the central bank simultaneously started to constrain the monetary levers quite significantly. So you see the liquidity in the system starting to dry up quite significantly by Jan 24, and then they've held it consistent at that level for quite some time now. The other way to interpret this is that the last 1 year has been quite unusual for India because the growth in money supply is actually lower than the growth in nominal GDP that the economy has encountered. So about 10% nominal GDP growth and about 9.5% money supply growth. And that, if nothing, is the textbook definition of a restrictive monetary policy. So India's policy settings have been restrictive, both on fiscal and monetary, and growth to some extent has been the casualty of this outcome. Moving on to the next slide. There has also been administrative intervention by the Reserve Bank of India, arguably for all the correct reasons. They were concerned about the growth in unsecured credit, particularly by fintechs going back to 22 and 23. So starting in the fourth quarter of 2023, they increase the risk weights on certain kinds of loans quite aggressively. They also push the banks to get their liquidity coverage ratios back in shape, to increase their bank deposit based liquidity. And as a result of that, credit growth, which was running at 15 to 16%, as you can see on this chart, slowed to about 13%. And in fact, it slowed even further based on latest data to about 11% year on year. So credit growth is still running slightly ahead of nominal GDP growth, but not by much. Historically, credit growth in India has tended to run at about 1.4 to 1.5 times, nominal GDP growth, because at the end of the day, the country is underbanked or underserved, particularly in terms of credit. And when you look at the private corporate sector debt to GDP, or you look at the household debt to GDP, these are very, very low numbers. So typically credit has grown much faster, but this administrative tightening of credit has resulted once again in some slowdown in growth. Moving on quickly to the next slide. Um, I won't spend too much time on this, just wanted to highlight. This is, of course, the economist forecast, professional economist forecast. The top row is instructive. You can see FY25, that's the year ended March, 6.3% growth estimate. And for FY26, 6.5%. The government and the chief economic advisor were both on record last week during the budget, and they are also talking at about 6.5 to 6.8% at the upper end in terms of GDP growth for FY26. So obviously, of those amazingly strong numbers that we saw in 22, 23, 24, but back to the kind of trajectory we had in FY18 and 19, which was at about that 6.5% level. We'll just jump through to the next slide. I just wanted to show you the GDP growth numbers here. We'll quickly take a look at valuations. Now, the good news in terms of the Nifty 50 trailing price to book is that the valuations have dropped quite a bit. And as a result of that drop in valuations, you are now trading well within the fair value zone. And on the right side, if you look at return on equity, what you will see is that return on equity has moved up quite significantly since the pandemic, and on historical basis, this is a very comfortable level of return on equity. Moving on to the next slide. This shows you the picture in terms of mid cap and small cap valuations. I think the 2 points to make here is that these two parts of the market are expensive in absolute terms. And further, if you look at this part of the market relative to the large caps, they're actually trading at a premium. We've seen this happen in the mid caps in the past as well, but small caps trading at a premium to large caps is unusual. But again, this is one of the challenges the Indian market has faced, which is very, very rich valuations in the mid cap and the small cap space. Moving on to the next slide. So this is just sort of a summary slide to, talk through some of these issues that I wanted to place in terms of the macro context. Expectations for US Fed rate policy cuts have obviously moderated, and, I've not put any slides on this, but you're all aware the tariff and the trade wars, which are currently, sort of raging over X, and on a daily basis, discussions about what might happen. None of this makes it very easy for policymakers to sort of stick to their objectives. They're having to sort of respond to data. They're worried about policy changes, which could have dramatic implications on the metrics that they are tracking. And therefore, I think pretty much everybody is in sort of wait and watch mode, whether it be the US Federal Reserve, the Reserve Bank in India, and for that matter, I suspect even businesses and entrepreneurs are, at this point of time going to be slightly more prudent and cautious, because if you are making large investments, particularly in capacities for tradable goods, you are now very concerned about the ramifications of what's happening across the world in terms of tariffs and trade wars, and therefore you'd like for some of that dust to settle before you make any large, capital commitment or investment. The dollar has strengthened significantly after the US elections, in expectation of the higher import tariffs, looser fiscal policy, and potentially higher growth differentials vis-a-vis the developed world. The rupee has weakened vis-a-vis the dollar over the last 4 months, but while it has been weak, I would say when you compare it to other global currencies, the rupee is actually doing quite well. And I'd just like to make a point about how India's focus on macroeconomic stability is working out to our advantage. The US has cut rates by 100 basis points in the last 4 or 5 months, but that 10-year bond yield is actually up 80 basis points, and that's a reflection of everything that's happening within the US system. You look at India, there's been no cut in the short-term interest rate. The RBI MPC board meeting happens on Friday, so we'll see if they cut rates. But look at the 10-year yield in India. It's been rock steady. It's not moved at all over the last 6 months, despite these spikes in the US bond yield. And I think what that is basically reflecting is the continued focus on fiscal consolidation in India. And therefore, these policies, be it fiscal or monetary, while I could also call it restraining of economic growth, they're also very conservative. And I think, therefore, it keeps the Indian economy on a very strong platform to be able to respond to any of the challenges that are likely to arise as a result of all the volatility that we are seeing in global environment, not just in markets, but also in the economies because of all this talk of tariffs and trade wars. We do expect some incremental easing by RBI, or rather by the MPC during this year. Our base case still remains 50 basis points of rate cuts in India during this year. And the RBI seems to be comfortable enough to address the tight liquidity situation. Nifty 50 consensus earnings growth for FY26 year ended March 26 are in the low teens. I would not describe this as a low bar because nominal GDP growth in India seems to be settling down at about 10%. So, generating 13-14% earnings growth for the Nifty 50, 15-16% for the broad, Nifty 500 index is not easy when nominal growth is running at 10% unless you start to presume significant operating leverage benefits, pricing benefits, and operating leverage benefits flowing through to the bottom line. So it's not a high bar, but it's not a low bar either. The mid cap and small cap are trading at expensive valuations, still an area of concern. The good news, I think, particularly, and Ajay might talk more about this, is that I think very clearly now we can see a pattern over the last 6 to 9 months where there is a trend reversal in favor of quality growth from value. As far as the large caps are concerned, the point that I would make is that large caps in India actually are now back within the fair value zone. There was a period of time where they were trading rich, but they are now well back within the fair value zone. So that's about it from my side. I'll halt here and hand over to Ajay, and he's going to be talking more about the IDEF strategy.
Sure. Thank you, Vetri, and good afternoon and good evening, everyone. What we'll do is, as is customary, we'll just take a quick recap of our investment philosophy before we go into specifics. So, like we've always maintained, UTI India Dynamic Equity Fund, or IDEF as we call it, basically believes in buying high quality businesses, which to our mind are the ones which exhibit high return on capital, have strong cash flow generation, and therefore create economic value each day, each month, each quarter of their existence. So our North Star clearly is focusing only on businesses which are creating and compounding economic value, and they compound economic value faster than the overall economy because of they being growthy in nature, they being into industries which have penetration levels that are significantly low, thereby providing a long runway for growth for businesses that are part of that industry. So, our portfolio is constructed at the intersection of quality and growth. I will take you through a few slides about style rotation. While data is very clearly in front of us in terms of how high quality companies in the fullness of time have created substantial alpha compared to underlying benchmarks, and it could be MSCI India, it could be the broadest benchmark available in India called Nifty 500 or NSE 500. It obviously doesn't mean that such businesses outperform in each point of time in the cycle. We have gone through a horrible phase over the last 2-3 years, but there is data to suggest that there has already been a turn towards quality from value, and we'll share that with you in the subsequent slides. Last point here on the philosophy, which I wish to reiterate here, like I've done in the past, we are not buy at any price. Many of you who've been investors in the strategy for long would have also noticed that after identifying a business, we don't mind waiting for a few years to scale up the position meaningfully. So we are extremely patient. When we identify a business, we don't wish to pull the trigger and create large positions immediately. We give ourselves a few quarters, sometimes a couple of years to build meaningful positions, because obviously we don't want to buy at a price which doesn't make sense in terms of valuations. So moving on, let me now take you through the performance. Uh, the long range performance is on the top in terms of performance for every calendar year. What you see at the bottom is the rolling performance. And like I was mentioning, there certainly has been a movement away from value into quality. And whenever these things change, the movement can be very fast and very swift, to the extent that the performance numbers also start to change very swiftly. So as you can look at the bottom, on a 1 year basis, the strategy is outperforming the benchmark by over 6%. This number till a few months back was mid single digit negative. And of course, this has all changed post, I would say, June, July of last year. We did see the numbers for 3 months and 6 months changing initially, but now it's also showing a strong performance on a 1 year basis. Of course, the challenge remains the 3 year numbers, because we did have a very, very poor 2022. So hopefully that should also come back in order. Like I said, our North Star remains being focused on businesses that are creating economic value. So long as we have such businesses in the portfolio and we remain convinced about them and we continue holding on to them, we have absolute confidence in terms of long-term alpha creation like we've done in the past. If you move on from here, let me now take you through the key contributors as well as the detractors for our performance. The key contributors over the last 1 year have been some very high growth companies like Dixon, which is basically India's #1 company in electronics manufacturing and outsourcing. And this company has had a big advantage and a big tailwind because of the policy of the Indian government to push for manufacturing in India. And they've chosen a few sectors. Electronics is one of them, and within electronics, mobiles, laptops, PCs is the area of focus for the government. Dixon is that company which actually has been able to, take the biggest advantage of this policy that came in, and it's executed very well compared to all other competitors. Uh, of course, it's very growthy, as some of you may already be aware, but what is also satisfying for us is that it's done this without raising debt. It's done this while maintaining return on capital, and it's done this while using its own cash flows for reinvestment. InfoEdge, a portfolio stock which has been there with us for almost a decade and a half now. India's #1 internet business continues to do very well in its core categories. By the way, InfoEdge is also the #1 investor or the largest investor in Zomato. So it's also had an advantage in terms of its holding in Zomato. And we all know that Zomato has done very well over the last couple of years. Trend is India's largest fast fashion business. You can think of Zara to some extent. And this company too has done very well in terms of rolling out of its stores across the length and breadth of the country. IT services is the next one. It wasn't particularly doing well through 2022 and 2023, but we kept maintaining positions in IT services. We kept maintaining an overweight position within IT. We've been more overweight on the mid-tier companies, which clearly are doing a better job in terms of growth. Maybe the size is their advantage as compared to the larger ones. And these companies have actually helped us over the last 1 year. Healthcare too has done very well. Part of it is China plus one. Part of it is on account of some differentiated business models that we have in our portfolio. Last but not the least, avoiding cyclicals, which did hurt us in 2022 and 23, has started benefiting us starting the second half of 2024. The key detractors have been predominantly a lot of these consumption names. I'll come to this in a bit later on, but consumption has been a big drag over the last couple of years in India, and that is why the government, also in the budget gave sops to the Indian middle class, because they do want to kickstart consumption, and because they certainly are aware that consumption is the bedrock of growth in India, and if consumption starts to falter, then we are really looking at growth rates in India slowing down substantially. So in order to fix this problem, the government has tried to bolster consumption by giving certain tax benefits to the Indian middle class. More on that later, but essentially what we are trying to see here and show here in our key detractors are names across different categories of consumption which didn't perform well over the last couple of years because their earnings growth were slower than what we would have expected. Let's move on. Now, this is one data which we thought would be a very interesting one for our global investors. Uh, and we thought we should share this with you because this would put into perspective that, why is it that we are not so positive on mid caps at this stage? Of course, one big reason is that valuations are significantly higher than long-term averages. Vetri showed you those charts. Uh, but there are reasons beyond that as well. Equally, why are we so positive on quality? Again, one reason is that on a relative basis, quality's valuation compared to its own long-term averages is at a lower premium compared to where we see value today, as in the value part of the market today. So in order to establish some of these facts, we thought let's look at data going all the way back to 2005. So we have a 20-year data in front of us. We've for our study, we've basically zeroed in on 4 benchmarks. Nifty 500, which is India's broadest benchmark, it covers large, mid, and small. Uh, Quality, which basically, as the name suggests, is trying to cover the quality part of the market. Value part of the market is covered by the value 50 index, and lastly, the mid cap 150 index. So these are the 4 indices which basically are picked up by us for the purpose of this study. We take daily values for each of these 4 indices, and on a daily basis, we try to calculate 1 year, 3 year, and 5 year returns. So we have thousands of rolling 1 year, 3 year, and 5 year returns. Even in the 5 year bucket, we have 3,684 observations. So very large sample set, which gives us this confidence that the end result should actually not be incorrect and should be more right than wrong. In any case, we've tried to cover or build a hypothesis using 3 different return buckets: 1 year, 3 year, and 5 year. And the study basically shows that all 3 of them point in one particular direction. Lastly, what we have done is when we have these observations in place, we have divided the market into 3 phases. Bullish phase, as represented by markets giving 15% or higher returns on a CAGR basis. Bearish phase, as defined by markets giving negative return, again on a annualized basis, right all the way up to 5 years. Lastly, a more normative or rational phase of between 0 to 15%. Now, if we start from the bullish phase, which is at the last row, the third row on this study, you would see that whenever markets are bullish, the best performing factors or the best performing indices are value and mid cap. And it's very intuitive when markets are bullish, when animal spirits are out, when people are seeking to take more risk. They obviously don't want to invest into very stable, high quality businesses. They are happy going down the quality curve because they're not interested in making very stable returns and protecting downside. They're more interested in multiplying their capital. They're more interested in identifying companies which can re-rate, given a much more, given a better overall economic environment, as well as a market which is extremely cheery, and therefore they are looking for multi-baggers, and that they are able to find only when they go down the quality curve. So over a 20-year period, whenever markets have turned bullish, it has always been the value style which has done exceedingly well, significantly better than quality. Equally, by the very same logic, or I should say similar logic, whenever markets are bullish, mid caps do much better than large caps. Again, it's the same thing. People are looking at multiplying their returns rather than downside protection. People are more risk taking, and that behavior takes them down the market cap curve as well. The second bucket is basically when the markets are more rational, and this is where the mood changes, and perhaps this is why in India over the last 6 months you see the mood shifting towards quality and again more towards large caps. As markets tend cautious, investors now want to actually start moving towards more stable returns, towards more stable business models which have strong balance sheets and cash flows and so on. And as you can see in the middle row, the minute this mood shift starts to happen, as we are already seeing in India right now, quality starts to give returns significantly higher than all other factors. The last bucket is when the markets turn outrightly bearish. I think it's only intuitive and fair to assume that whenever markets are bearish, people will lock, stock, and barrel, move to the best managed companies, and they will just exit mid caps and small caps because the weaker businesses in poor market environments don't do well. So I think this ties up very well with what Vetri showed you. The valuations for large caps are much better than in mid and small caps because mid and small caps have enjoyed a very long party of the last 3 years, which has rendered their valuations into crazy territories. That's point number one. B, like I mentioned, as the mood shifts and changes, people anyway want to gravitate towards more quality companies. So I think these are the factors which have just started playing out. Our analysis suggests that these phases last a few years before animal spirits turn back again. In the context of valuations, like I mentioned, valuations are also favoring large caps and quality businesses in any case. Let's move on. Uh, like I've been mentioning a few times in the last few minutes, the mood of the market has already changed. Let me first take your attention to the table on the left hand side. If you look at 2022 and onwards, which is 22, 2023, 2024, and also 2020, 22, 23, and 24, these 3 years, along with 2021, each year quality underperformed value, and that too significantly. 30% every year on an average. And even in 2024, the year where we saw the pivot shifting and moving towards quality was also on a full year basis an underperformance by quality. But if you look at the right hand side table, what you can observe is that starting May and June of last year, quality started outperforming and continued doing that each month, including the last month, which is Jan 2025, that is, except for that 1 month of October 24. So very clearly, we are witnessing that shift in favor of quality in line with the overall market sentiment. Yeah. Let's also look at how the strategy has performed in the fullness of time, which is since inception. And this study is about how we have created alpha over different time periods, over 1 year, 3 year, and 5 year time periods. Again, what we have done is we've taken rolling returns right from the first NAV date of 1st Jan 2011 for the strategy on a 1 year basis, on a 3 year basis, and on a 5 year basis, taken an average of all of these returns. And what we see here is that whether you measure our performance on a gross basis or on a net basis. So gross is gross of investment management fee, but net of all expenses, including capital gains. Net obviously is net of everything, including investment management fee. In the all the three buckets, whether we see 1 year rolling return, 3 year or 5 year rolling returns, we have actually outperformed the benchmark in case of 1 years. And I'm only talking about net numbers right now so that we don't use too many numbers here. On a 1 year phase, 73% of the time we have outperformed the benchmark on a net basis. On a 3 year rolling basis, we have outperformed 80% of the time. On a 5 year rolling basis, we have outperformed 83% of the time. So clearly, when you measure our numbers today on a 3 and 5 year basis, we are underperforming. But please do appreciate this has been a brutal phase for quality, where quality has massively underperformed. We are just coming out of that phase. But if you consider the performance of quality and the performance of our fund, as you can see, and as these numbers corroborate, majority of the time, as high as 80 or 83% of the times, we do outperform on a 3 and 5 year basis, net of all charges. Yeah, let's move on. So, there are a few stock examples that I've taken here, but I think this time we thought we should leave more time for questions. So I will not spend too much of time here, maybe just 30 seconds each. So Titan is is the largest jewelry player in the country. We have been holding the stock for more than 10 years. The beauty is that it's a very large market, $58 billion, in size. That's the overall size of the market. But Titan still, despite growing at almost 20% for 20 years, is still only 8% of the market. It's the market leader, but only 8% market share. So, this is an industry which is shifting from the unorganized small mom and pop jewelers to the organized guys. Titan is at the forefront of this shift. Without compromising on margins, cash flows, balance sheet, this company has been marching ahead with a very strong and steady growth rate. As you see here, we still feel that we are in the early laps of this journey from unorganized to organized, and we remain bullish on this company, and it remains as one of our top 10 holdings. Move on. We've picked up a IT services firm this time. This was also showing up in terms of our key contributors to performance. A relatively mid-sized IT services firm called Persistent Systems. It's very strong in engineering, R&D, and high-tech vertical. Has shown very strong growth over the last decade. But again, like Titan, we feel that the size of the company is, extremely favorable in terms of continuing to enjoy high teens growth for very many years to come. And in the last 2 years, while the IT services industry was under some pressure because IT budgets in US were more or less frozen, and they were showing very, very tepid growth. But despite those challenges, this company continued to grow in mid-teens. So, as the environment gets better, our expectations are the company can deliver, much better growth. Let's move on, Ravi. This is the sectoral weightage across the two time periods present as well as exactly 1 year back, and you'll see not much change. Our churn ratio remains very low. It still remains about 10-11%, so you won't see wild swings. But yes, we continue to remain negative on sectors like energy, infrastructure and construction, metals and mining, utilities. These sectors hurt us a lot in 2022 and 23, but we are already seeing signs of these or being underweight in these sectors benefiting us in the last 6 months. And we've been absent in them because we are unable to pick businesses with strong economic characteristics, i.e. quality and sustainable growth. And that's the reason why we have stayed away from them. But clearly there are years when not owning them can hurt us. Yeah. Let's move on. This is the top 15 holding. Again, not much change. There will obviously be some mark-to-market change. There will always be some change because maybe we are ramping up a position. So what you can clearly see is that Zomato was not part of top 15 last year. It was a relatively smaller weightage of around 1.5%. But we ramped up the position, and there was also a big mark-to-market gain. Similarly, Trent was also not part of the top 15 earlier last year, but we've been ramping up the exposure to Trent. So, while we don't swing, but they can always be certain companies where we've been actively building exposure, and they can show up in our top 15 holdings. Yeah. So that's about it from our side. Let's get into Q&A, and happy to take your questions along with Vetri. Yeah.
Thank you, Ajay, Vetri, and Shweta. We'll now open the session to Q&A. The first question for you, Vetri, is what is your assessment of the budget announced recently? Are there meaningful triggers in the budget announcement to support growth? Is there a risk of deficit increasing if growth is lower than expected?
Sure. Always the season to discuss budget because it's presented on the 1st of Feb every year. I would say the materiality of the budget in terms of influencing India's, medium-term growth trajectory is actually quite limited. The era in which a lot of big economic reforms were carried out in the budgets dates back 20 or 30 years when there was a massive reform agenda ahead of us. Today, the changes are more at the margin, though this budget, I would say the biggest change that it carried over was actually a very big supply side initiative on personal income taxes. There was a dramatic rationalization rationalization and cut of the personal income tax, reminiscent of what the government of India did in 2019 when they did a very significant tax cut for the corporate sector. What this tax cut does is effectively put in the hands of households close to about $14 billion of income by way of tax rebates that they would get. Effectively, it's a tax cut to them, and then it's really up to the households to decide how they would like to use that $14 billion, whether it might be to consume, whether it might be to pay down some debt, or for that matter, they could choose to invest. So I would say there's a very material supply side initiative that the government took this time around, rather than determine what they would do with the revenues directed to fiscal transfers, directed to revenue expenditure, directed to capital expenditure. They just said we leave it with households, and they are best placed to decide what really would benefit the household and the family the best. Beyond that, I would say the government stayed on the path of fiscal consolidation. The tax cuts amount to about 0.3% of GDP. Despite that, you are actually seeing a 40 basis point reduction in fiscal deficit as per the target. So 4.8% fiscal deficit coming down to 4.4. That's the target. And that in spite of 30 basis points of GDP being foregone by way of tax revenues because of the personal income tax rate cut. Secondly, I already mentioned this in my opening comments, but this effectively brings the fiscal deficit in India back to the trajectory where it was in 2019. Now go around the world, look at the map and see how many countries in the world have brought their fiscal deficit back to the pre-pandemic trajectory or the pre-pandemic year. And India stands out as one of the countries which has managed to do that and is doing that. The budget also took a slight more medium-term stance towards fiscal consolidation. Government of India now says rather than work with annual fiscal deficit targets, we want to bring down debt to GDP. The union government's debt to GDP is estimated at about 57 to 58% for this year, and the target is that by 2031 they would bring debt to GDP of the union government down by about 700 basis points down to about 50% of GDP, which would bring total debt to GDP, presuming the state debt to GDP did not change, that would bring the aggregate number down to about 72 or 73%. Once again, India's fiscal conservatism relative to a lot of economies who've punched past the 100% mark in terms of debt to GDP, very, very visible. So I would say certainly some attempt to use supply side policy to promote growth, but not at the cost of sacrificing macro stability. I think the sort of unstated point on which I'll end is that as much as government of India likes to talk about India being among the fastest growing major economies, I would actually say increasingly their behavior points to their number one priority actually being maintaining macroeconomic stability of India. And in some of our conversations with government officials, this comes up very often that when you're dealing in an uncertain world, today it's because of President Trump and the tariffs and trade wars. Last year it was because of something else. It was because of what the Fed might do or might not do. It just helps to have your house in order and to be conservative so that you have the ability to respond when unexpected events do take place.
Thank you, Vetri. The next question for you, Ajay, is with the recent correction in equity markets, are you using this opportunity to add new names to the fund?
I would say, Neha, not exactly new names. So, by the way, we always go with an open mind. We always we've always maintained, we have some companies on our radar all the time. So I can tell you what has happened over the last few months. We've actually added more to the existing names, which have fallen disproportionately. It's the nature of the market to punish the high beta names during corrections, and that's just how this thing works. So in our portfolio as well, there have been certain names which are doing very well in terms of the underlying business, in terms of the expectations, but just because they've gone up too fast, they've also seen a brutal correction, and we've been adding to some of these names. But yes, there are a few names on the radar which we are closely watching, which have also seen uh, a sharp decline or a sharp correction, we may be, adding some of those names. Yeah. What I do
Thank you.
want to say is that we will never come out of our core area and our core sphere of quality and growth. So whatever we do will always be within the confines of quality and growth. That's the one thing that I wish to state. Yeah.
Thank you, Ajay. The next question for you, Vetri, is growth in India is expected to be low in 2025 at about, let's say, 6%. Is this lower than expected growth persist? If this lower than expected growth also persists long term, do you see headwinds for Indian equities?
Well, that's a fair question given the recent outcomes, but the only point I would make is that we should not be committing the error of presuming India's growth rate is 8% when last quarter's GDP print was 8%, and neither should we be committing the error of presuming that India's GDP growth capability is 5% when the print is 5.5%. So really the way I look at it, India's growth capability based on our domestic savings and some contribution from FDI allows us to sustain the economy quite comfortably without sacrificing macroeconomic stability at about 6 to 6.5%. Then based on what might happen in any given year, you could see it cross 7%, you could see it dip below 6%. So if we are looking at the Indian market construct as 6.5% GDP growth, let's say that's the central tendency, then I don't see any reason to feel very despondent about recent trends. We should not underestimate the fact that this macroeconomic stability is critical to enable us to achieve the targets and hopes that we have to grow consistently over many years. Somebody of my vintage, I've been in the markets in 2003, well, even before 2003, but 2003, 2008 was a period where growth averaged almost 8%. But in retrospect, when I look back, we realize that there were significant amount of macroeconomic imbalances and stresses which built up during that period. And then we spent the next 5 to 6 years cleaning it all up. So I would actually believe that the policymaker thought process to maintain macroeconomic stability in this kind of an uncertain environment is something very good. You'll often hear us talk about our growth aspirations being 8% and above. Well, those are our aspirations. Great if we can get there in a way that we wish to get there. But I don't think we should restructure the economy, to gun for 8% and open ourselves up to unnecessary risks.
Thank you, Vetri, for that. Next question for you, Vetri, again, is do you think higher valuations will be more difficult to justify in a lower for longer India growth scenario?
I think that's a pretty good question. When I look at the Indian market over, let's say, 20 plus years, nominal GDP has compounded at something like about 12 odd percent. Corporate earnings, depending on, we are starting at ending point, roughly again sort of averages that same CAGR of about 12%. The long-term return from Indian equities, all of this being in rupee terms, is about 14.5 to 15% over that same 20-year period. The reason it's slightly higher than the earnings growth is simply the compounding effect of total returns, which includes the reinvestment of dividends. So that's the primary source of the gap. It's not so much valuation changes. Now, I would submit that perhaps over the next 10 years, as of now, our base case would be that nominal growth would be slightly slower. I wouldn't necessarily expect that 12% number that's coming from this focus on macroeconomic stability, accompanied with the fact that the inflation numbers for India today are targeted at 4% plus or minus 2, rather than a previous era where we were very comfortable with 6, 7, 8% inflation. So the structure of real GDP growth has changed. But equally, the other factor which is therefore changing is that we've got much lower interest rates, and I would submit eventually much lower real interest rates as well in this current environment, because it's a function of that same macroeconomic stability. And therefore, I would say whatever little bit we might have sacrificed in terms of the nominal GDP growth, nominal earnings compounding, I think some of that can be recovered just by the fact that cost of capital and your cost of debt would be so much lower because the macroeconomic platform is so much stable. So I don't think it would change my thought process too much in terms of the expectations for INR returns over the next 15 years. And just one final point, I think I've normally, whenever I've spoken to investors, talked about a 2 to 3% per annum expectation of depreciation of the Indian rupee vis-a-vis the dollar. I know the last few months, once again, we are seeing, a sharp move in the rupee. But to my mind, that's more about dollar strength than it is really about weakness in the Indian currency. But if I were to think about the next decade, I think if India stays on its current trajectory where macroeconomic stability is really been the unstated priority number one, and if the US in particular continues along its, what I would call a profligate path, then I don't think the currency depreciation will continue at 2%. I think the outcome could be far more favorable for dollar-based investors. So that's the way I think about returns in the future.
Thank you, Vetri. The next question for you, Ajay, is quality stocks have been outperforming in the last 6 to 7 months. So, what are the triggers behind the shift in momentum? And do you think this is sustainable?
So Neha, we did spend some time during the initial part of the presentation, and we did show a lot of data around the fact that the mood of the market seems to have changed towards quality. This is happening at a time when investors are becoming more cautious about the markets, and the caution is on account of multiple things. One is on account of valuations, and valuations, particularly in the value bucket, going significantly higher than the long-term averages, plus the fact that overall growth this year has come in lower than what we would have expected. Add to this the fact that there has been a bit of global uncertainty on account of the geopolitics, on account of the new US administration and the possible tariff war. So this is just the perfect setting for investors to pivot away from value towards quality. With everything else in financial markets, there is a trigger that always leads to a shift and leads to a change in direction. I think the few things that I just mentioned have triggered the shift away from value to quality, which anyway was long overdue. But so that's one part of the story. The other is that, see, in the fullness of time, what we've always maintained is that it's the outcomes of businesses which will determine how well they do as stocks, and whether they are able to create alpha for their long-term investors or not. And we remain extremely sanguine about the outcomes of the businesses. That's the thing which has given us the conviction to hold on to them through good times and bad times. That is what we are tracking. Uh, while we don't have that slide handy right now, but we can send it later on to our investors on this call. We've always shown the big difference in the growth outcomes, both at the revenue level as well as the profit level for our portfolio, which is a high quality, high growth portfolio versus the benchmark. That is giving us confidence, and that hasn't changed a bit despite the underperformance over the last 3 years. The portfolio does a better job in terms of growth. It does a significantly better job in terms of profitability as measured by return on capital. And equally, it does a significantly better job in terms of cash flow generation. So all of these things are giving us that conviction that the U-turn that we have seen is going to be, what will be the outcomes in the stock markets as well over the coming years.
Thank you, Ajay. We have another question for you. What are the EPS expectations for small and mid caps for 2025 and 2026?
So, Neha, the biggest joke in the Indian markets is that all analysts and fund managers start the year with a mid-teen kind of growth. That's the safest number to work with. and by the end of the year they mark it down or mark it up depending on how the quarters are panning out. So the number today, because we are starting 2025 and we are far away from 2026, is once again a mid to high teen number. But our experience tells us that the final outcomes could be very different. So please don't pay too much of attention to this number. To our mind, the number could be lower teens rather than the consensus number that you see on the Bloomberg. The number eventually would be lower teens. But there is one thing, since you've asked me this question, there is one thing which I want to talk about here. Let the number be anything on the Bloomberg consensus today, and then let that number be 5 or 6 percentage points higher than the same number for large caps. But we have done this study right from mid 2000s to date, and we all know that in statistics, the starting point and ending point can mean a whole lot. So you can prove any hypothesis by choosing your starting point and your ending point. Therefore, at UTI, we never do any study which has one particular start date and end date. We always use rolling data. So on a rolling 5-year basis and rolling 10-year basis, we have made a comparison between mid cap and small cap EPS growth on one side, and on the other side, large cap EPS growth. The fact is that whether you look at a 5-year rolling data or a 10-year rolling data, the difference is just about 1.5% points. Depending on the mood of the market, sometimes you see people forecasting a significantly higher growth for mid caps comparing to large caps, and then build a narrative that yes, you ought to be in mid caps because look, they're giving you such strong outcomes. And during bearish phases, they try and do the reverse and say, look, mid caps are going to massively undershoot in terms of earnings growth. The fact remains that for investors who really call themselves as long-term investors, the difference is just about 1.5% over rolling 5-year and 10-year period. So long story short, we think that this year for mid caps would be low teens and not the consensus as we see on the Bloomberg, which is high teens. Yeah.
Thank you, Ajay. Another question for you is how the union budget in 2025 that just released, if it could have an impact on the IDEF portfolio allocation, would it favor quality growth strategy? Any thoughts on that?
So I wouldn't say that the budget favors quality growth strategy. I would say that the budget certainly is pro-consumption. Vetri did allude to the fact that within the confines of what the government can do, and they have committed themselves to a 4.4% fiscal deficit within that confine, and of course they have given a tax incentive to the middle class. So therefore, the revenue collection is going to be lower to that extent. And of course, fiscal deficit, narrower than last year. They obviously are going to spend less on certain things, and those certain things are basically, the capex related items for the government, and they are making a very strong effort to revive consumption in the country by doing multiple things. So more than the style, which is quality versus value, I would say we've been overweight on the consumer sector uh, for forever, I would say, because we consider these are the businesses which are extremely scalable, profitable, which don't get disrupted so easily. And I think this is the sector which hasn't fired in the last 2 3 years. I did mention consumption in India has been slow, so the constituents of these industries, the companies in these industries, have also not fired over the last 2 3 years. But I think very clearly the focus of the government is on reviving consumption, which will benefit our portfolio. Yeah.
Thank you, Ajay, for that. The next question, maybe for you, Vetri, is earning growth in the past couple of quarters have been muted. What are the reasons for this slowdown, and could there be a driver for revival?
Sure. I'll just finish off with something Ajay pointed to. He talked about the personal tax rate cut, and obviously that leaves money with households. Now it's up to them where they choose to deploy it. But there is another tailwind for consumption, as whether you like it or not is a different issue, is that in the last year, you've seen significant number of state governments increase the pace of fiscal transfers to households, right? So the personal tax rate cut flows only to households which pay income taxes. But there have been significant fiscal transfers that individual state governments have announced to what I would call even lower income households. So when you start to add all of that up together, it does amount to a very significant pot of money. I mean, the handouts in just the state of Maharashtra and Karnataka put together, which is two out of our 30 odd states, would more than equal the annual run rate of the tax cut that the union government delivered. So I do think there is a lot more money from the government flowing into the pockets of individuals. And to that extent, there is a more generalized tailwind, at least for consumers in terms of the consumption theme. Your question to me was in terms of the earnings growth expectations. This year is going to end up being a disappointing year, pretty much in the line of what Ajay described earlier. FY25 started with a mid double digit earnings growth expectation, seems to be ending on a fairly tame note with just about mid single digit earnings growth is what we think. Next year's expectation is about mid teens, low to mid teens, 12-13% for the Nifty. And as Ajay pointed out, for the mid and small cap, it's actually closer to 18 to 20%, which sort of boggles me beyond a point, because if you've got nominal GDP running at, something like about 10-11%, then how are you going to get these mid and small cap companies in aggregate? I'm not talking about individual companies growing at 18 to 20% a year. I mean, we've never seen that kind of divergence. Doesn't mean it can't happen, but I would estimate it to be a fairly low probability event, and which is why we think there's actually a lot more relative safety in the large caps. Even that mid-teen outcome for earnings growth for large caps it's not a low bar. It's not a low bar because a lot of the margin efficiencies already got squeezed out in FY23 and 24. So it's not very clear to me that there is room for margins to significantly contribute to profitability in 2025. So, I would say that low to mid-teens number is a reasonable number, and a reasonable amount of probability attached to it.
Thank you, Vetri. Maybe in the interest of time, we'll take one last question. Again, for you, Vetri, is foreign investors have been selling Indian equities over the last few months. So, in the current global context, do you think the selling will sustain? And under what scenario, in your opinion, can foreign flows start coming back to India?
Sure. Good question. Just, a few quick sort of ways to look at that. One is without doubt, foreigners have sold quite aggressively, but it would be very unfair of me to point all foreign investors as a homogeneous group, because knowing many of these investors as I do, there are very, very diverse set of investors. Those who look at long-term hedge funds, then you've got the beta plays with country funds who maybe keep rotating portfolios a lot more aggressively. So not a great idea to bunch them together into one homogeneous argument as what will foreign investors do. But in my conversations with, I would say, some of the larger institutions who've been involved in Indian equities for 20 to 30 years, I would say to some extent they've been as baffled as maybe you've heard Ajay and me in our conversations in terms of our response to valuations, which is that these valuations are just significantly higher than what we've been used to for many years. And I think that's one of the challenges that I see, at least particularly with some of the traditional long only investors who've had a fantastic track record of investing in India over many, many decades. Having said that, to my mind, a valuation correction is good enough for them to start looking at India again. The Nifty is down 15%. As I said, the Nifty 50, which is a large cap benchmark, is pretty much back into fair value territory. So to my mind, there is good reason to believe that you will not see the kind of widespread selling as you saw from, I would say traditional long only investors who certainly were withdrawing money from Indian equities for the better part of, I would say, in fact, all the way 23 and 24. So I think that will certainly come to a little bit of a halt. Finally, I'm not an expert on market technicals and market positioning, but I know my, desk which looks at passives has pointed out that the short position of foreign investors in Nifty futures in contract terms is close to a record, and therefore that could be some reason to suggest that there might be a positional shift underway. I think the data as of Monday was at the highest we've ever seen for foreign short positions in India. So yeah, that could just be a short-term, reversal point. But to my mind, valuations really would be the bigger reason why I don't think the pace of selling you saw in 24 continues in 25 as a whole.
Thank you, Vetri. And thank you all for taking out the time and joining us. If you have questions post this, feel free to reach out to us. And thank you again.
Thank
Thank you,
you.
everybody. Have a great day wherever you are. Regards.
Thank you.